Hey, it's Rob Weinberg, and on this channel, we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time here, go ahead, hit that subscribe button, and don't forget to get notified on all of our future content we're putting out every single week. In our whiteboard lesson today, we're going to be diving into avoiding common mortgage mistakes. Being in this industry now over 20 years, closing thousands of loans, I've seen the same mistakes made over and over and over again. No matter what's going on in the economy or the market, these mistakes seem to stay the same. So we'll dive into the mistakes and how you can avoid them. The number one mortgage mistake that I see is not having a mortgage strategy at all. And you may be thinking, well, what is a mortgage strategy? I'll tell you, if you don't have a mortgage strategy, that is your strategy. There's nothing there. So you need to have a strategy. What I'm talking about is the fact that a mortgage is a long-term financial instrument. You need to be looking at not only the short term of the mortgage, but also how are you going to manage this mortgage over time? Generally, people only keep their mortgages 3 to 5 years. That can depend on some economic factors, but you need to understand that taking a 15 or 30-year mortgage, you're likely going to be restructuring, refinancing, and changing that mortgage over the course of its lifetime, okay? So you really need to begin with the end in mind and have a knowledgeable advisor that can put into place for you not only the strategy for you buying the house or getting that mortgage today, but also what is this going to look like in 12, 24, 36 months? What is this mortgage going to look like in 5 or 10 years? And what steps do you have during that timeline to get into a better financial situation? If you have the right mortgage strategy, you can use your mortgage and your home equity to really increase your net worth and enhance your financial position. So mortgage strategy, super, super important. The next thing that I see a lot of buyers and people refinancing also make is that they don't evaluate all the different sources of the loans, or they think that their bank or credit union is the only or the best source for getting a mortgage. So you want to evaluate different options for getting a mortgage. There are different channels by which you can go to get a loan. For example, you've got your banks and credit unions, you've also got correspondent lenders, and lastly, you've got mortgage brokers like myself. I'm partial to a mortgage broker because we have access to hundreds and hundreds of lenders. That means that if your situations may be a little bit more unique, or you were denied or declined by a local bank or a mortgage banker, we might have a fit for you. We might have a different loan or a different bank that we can place you with who actually has that program, who can actually make your loan and fund your deal, okay? So you wanna look at all different options and all the different sources when it comes to getting a mortgage. You may also find price discrepancies, whereas by a mortgage broker may be able to get you a lower interest rate or lower fees than one of these other channels. So look at all of them to make the best decision and get the best deal for yourself. The last common mistake I want to discuss here today is going to be interest rate and evaluating a mortgage only based on interest rate. So what I see a lot of people do is they'll look at multiple options for loans, but they'll simply gravitate to the one with the lowest rate, and that's all they look at. They don't evaluate the terms, the fees, they don't compare apples to apples, they just simply look at that rate is better than that one, so I'm going to go with the lower rate. What we found is that many times the lowest rate is actually the highest cost mortgage, because mortgages have different pieces to this puzzle. You've got the terms of the mortgage, you've also got the interest rate, but you've got fees and closing costs. And the one part that a lot of people don't compare or don't compare correctly is the points, the fees, the closing costs. So be very careful and use an official loan estimate from the lenders that you're comparing to really compare line by line and make sure you are comparing apples to apples. You want to evaluate not only the rate, but again, the entire loan scenario and also the plan that's in place over the long term, as we discussed in mistake number 1. So for the remainder of the video, we're going to talk about some other mistakes I see in other scenarios. For example, real estate investors. So what I do see a lot of the time is first-time real estate investors get really excited about buying a property and expanding their portfolio and building wealth for themselves, but they make these same mistakes again over and over. So the number one mistake I see the real estate investors making is they only evaluate a property or a deal based on the gross rents. So they simply look at what is the gross rent, meaning how much rent is coming in per month versus how much is going out in a mortgage payment, tax, and insurance. And then they look at that as the end all be all, and that's going to be their profit. Unfortunately though, an inexperienced real estate investor doesn't realize the other expenses of owning a property. For example, the maintenance of the property, the holding costs of a property, especially if you're holding a property in the winter, it can be a significant holding cost monthly to keep things up, keep things good to go. So you need to also consider that, because a lot of the time, if you don't look at all the factors, you're going to end up in a negative cash flow situation or a deficit. And that's why a lot of first-time real estate investors don't succeed, because of these type of mistakes. The other mistake that I want to discuss here about real estate investors is going to be overestimating the market and not being realistic. So we've had a really good bull run in housing the last couple of years. It's been really, really hot. So a lot of people have seen success and they've seen these rents go up, but things don't go up forever. Trees don't grow to the sky, as the saying goes. So you want to understand and evaluate the deal based on the fact that the rents may go down. You may have other expenses that will come up. You may have other things that will eat into your cash flow. You need to be absolutely realistic and even put a doom and gloom scenario, a worst case scenario, and how you would be able to weather the storm as a real estate investor if that worst case scenario came about. Because what I found is my most successful real estate investment clients, they have a war chest, a savings, a nest egg, so that when things hit the fan or problems occur, they can just dip into that nest egg that they've got, that savings and reserve, and they can handle it without a big hiccup to their personal finances. All right, and the final item that I want to mention here in our lesson is going to be refinancing mistakes. You know, we've had these high rates for a bit. We're seeing them now start to drop. So it's looking like in the next year or two, there's going to be some great refinancing opportunities. So some mistakes that you want to think about avoiding if you're going to be refinancing in the future. First one is going to be taking the first proposal that you get. As I mentioned earlier, there are different sources for mortgages. Some are more expensive than others. You want to evaluate at least 2 to 3 different sources to make sure that you're getting a fair and transparent mortgage, meaning that you know what you're getting and it's the best deal that you can get in the market. So that's the first mistake. Next thing is not taking advantage of a higher value. So we've seen this run up in home values, yet we have a lot of people that still are sitting on a lot of equity. You may want to look at refinancing and structuring in additional cash out to handle financial needs, potentially maybe even a refinance combined with a home equity loan. There's different ways to take advantage of the built up equity in your property, but I see a lot of people make a mistake where they need money, but they're afraid to borrow it. So they end up 6, 12, 18 months later wishing and hoping, or I should say, wishing that they could go in a time machine back and hoping that they would have taken that cash again. So definitely evaluate both no cash out refinancing and cash out refinancing to tap some of that equity, because it may be a good move to kill 2 birds with 1 stone and handle future financial needs with today's equity. Okay. The other thing that I'll mention on the refinancing mistakes is going to be not taking into account future unknowns. So if you're going to be selling your home in the next year, it probably doesn't make sense to refinance because of that recoup time of the closing costs. You want to understand that, like, if you're taking a 15-year mortgage and you don't have a reserve, meaning you don't have a savings, you might end up in a situation where that mortgage payment is over your head, because a 15-year mortgage can be quite a bit higher payment than a 30-year. So you want to think about future financial issues that can occur. You want to think about the future unknowns, job loss, medical emergencies, things of that nature, and factor all that into your realistic decision to refinance today. Now, if someone you know or yourself are looking for a one-on-one personal consultation, I do offer that. You can reach out to me one-on-one by call, text, or private message at 860-413-3938. As always, I hope that helps, and we'll see you on the next episode. Take care.